Hello, everyone, and welcome to Thursday Talks with Chug. Each week, we cover pressing topics that matter to you and your business. My name is Arianna Gonzalez from Chug Attorneys and CPAs, tuning in from our San Diego office. Please join me in welcoming Senior Accountant Jaykumar Patel from our Atlanta, Georgia office. Hi there, Jaykumar, and welcome.
Hey, Anna. Hello, everyone.
Thank you so much for being here, Jay. For today's topic, we will be talking about the big, beautiful bill. Just a quick disclaimer before we get started. I'd like to remind you that this conversation is for informational purposes only. It does not create an accountant-client relationship. So if you do have any questions, please email us anytime at info@chug.com so we can help you out. So today, as I said, we're diving into the big, beautiful bill, a sweeping piece of legislation that's making waves in business, finance, and beyond. And to break it all down for you, we have our expert accountant, Jaykumar, here to guide us through it all. So Jay, I will let you take it from here.
Hey, hello, everyone. As we know that the House on May 22nd voted 215 votes to 214 to pass the HR1. HR1 is nothing but, as our Mr. President Trump mentioned, one big, beautiful bill. That includes the proposed tax law changes, increased fundings for border securities and multinational entities and national defense, and spending reductions affecting a large number of federal programs. The bill also includes provisions to increase the federal statutory debt limit by $4 trillion. It's a big amount for our debt. Bill includes significant changes to individuals, business, and international tax provisions. Today, I will be highlighting the reforms to GILTI, FDII, BEAT, and most important, Section 899. That is the new one, introduction into this bill. This changes really matters to multinational entities. So I'm going to cover the impact on multinational entities with introduction of this bill. I will start with changes to the GILTI and so on. So GILTI stands for Global Intangible Low Tax Income. It was introduced in 2017 with Tax Cuts and Jobs Act to discourage the profit shifting to low taxing jurisdictions. So when we know that multinational companies, they have like another entity, subsidiaries in another entity, another jurisdiction where there is a low tax, and they can just shift their profit from US to other jurisdiction, and then they will be paying the low tax on that. And to overcome on that, in 2017, they have come up with the GILTI. Under OBBB, that is again one big beautiful bill, the deduction is reduced to 49.2% from originally 50% on GILTI calculations. That will increase the effective US tax rate. The foreign tax credit haircut remains at 80% as before, raising the thresholds to 13.335%, and these changes will impact the tax planning and foreign tax credit utilization for multinationals. Another changes that I will discuss is the FDII, that is stands for Foreign-Derived Intangible Income. Introduced a while ago to give the incentives to US companies to export the goods and services by offering deductions. Bill adjusts the deduction rate to 36.5%, which is lesser than previous one, which was 37.5. So 1% is a reduction on that. But as mentioned, it is again favorable than the post 2025 scheduled to be like 21.875%. So with the introduction of this bill, again, the original rate, the current rate will be like 37.5%, and then it is going to be, after 2025, it's going to be 21.875%. But with this effect of this bill, it's going to be now 36.5%. Next is a BEAT. BEAT is like a base erosion and anti-abuse tax. generally targets the large corporations making the deductible payments to foreign subsidiaries and foreign affiliates. This bill sets the bit rate at 10.1% and removes the thresholds like 500 million gross receipt test. So before that, there was a test of 500 million, and it applies to the 500 million gross receipts and to very large corporations. But they are going to remove these thresholds, and the rate will be now 10.1%. It also disallow the general deductions and general business credits and treat the cost of goods sold related payments as a base erosion. There was a service cost method that is the exceptional before, but they are going to remove this exceptional. So now no service cost method will be applied when you are calculating the bit. The next, I would like to highlight the main important changes and main introduction is Section 899. This provision is targeting the discriminatory foreign tax regimes. Section 899 introduced withholding against the countries with discriminatory tax regimes like DST and UTPRs. It increased the withholding by 5 percentage points annually up to the 20 percentage and overrides the treaty-based rates. So whatever is the treaty-based rates between the US and Australia and whatever is the rate, but they are going to override it with this 899 section. So 5 percentage point annually with up to 20 percentage, it's going to be the big effect on US tax incomes. This will emphasize the compliance burden technically, and Treasury will public quarterly list of countries to which it's going to be applied and what's going to be the rate and all that. And the withholding agents like our banks and payment withholding agents, they must monitor this quarterly list, and they have to comply with that whenever the withholding will come into the picture. Section 899 affects the foreign corporations, governments, and trusts. Again, right now, the safe harbor rule applies until January 1st, 2027. But after January 1st, 2027, is going to be applied. So if you have any questions regarding this GILTI or BEAT or 899 section introduction and then FDII, you can have the questions for me.
Absolutely.
Over to you, Arianna. Thank you so much.
Yeah, so I know you were talking about Section 899 and BEAT. So can you tell us which entities that applies to?
So when we are talking about Section 899, it's technically which enhanced the section of the BEAT, and it's aimed specifically at corporations that are having the majority owned by the the persons residing into the jurisdictions, imposing the unfair tax regime. So when I say like majority, that mean like foreign entities or foreign persons from those like listed jurisdiction holding more than 50% into the US entities. So whenever any foreign person residing into that jurisdiction holding more than 50% into the US entity, to that US entity is going to apply.
Okay. And any strategic considerations that you would suggest to comply with the new bill?
I will say the first, evaluate the restructuring options, because, when you have like multiple entities and multinational companies, of course, there is a room for some kind of restructuring. They can do it to, check and then, comply with the procedures and then, minimize their burden of the taxes on that. Also, enhance the tax forecasting and modeling. Then prepare for increased audit scrutiny, of course. So must prepare the proper documentation and everything for enhanced audit scrutiny. And a multinational must act now to ensure the compliance and optimize the tax positions. That will be only my thought process on that.
Great insights there. As Jay mentioned, if you are watching this and need assistance or have questions, email us at info@chug.com. So one more question for you, Jay. You mentioned countries with DSTs and UTPRs. Can you tell us what is DSTs and UTPRs and what are those countries?
DST stands for like Digital Service Tax, and UPTR stands for Under Taxed Profit Rules. That is part of OECD's Pillar 2 Global Minimum Tax Framework. Certain countries with DST includes like Australia, Canada, I will Italy, and then Spain and France, I guess. Uh, Again, the countries with UTPR also includes like Canada and then New Zealand and South Korea, UK. Yeah, that's as per my knowledge.
Great insights. Thank you so much for sharing that. That is all we have time for today. So this brings us to the end of our conversation. Thank you everybody for joining us. A special thank you to you, Jaykumar, for taking the time to explain this bill and what it all means. To stay up to date, please subscribe and follow us on Facebook, LinkedIn, and YouTube. If you have any questions or suggestions, email us at info@truth.com. Let us know what topic you want to see next, and make sure to join us back here next week for more pressing topics that truly matter to you and your business. Until next time, stay safe and take care, everyone. Thank you again for joining us. Thank you, Jay. See you next
Thank
time.
you. Thank you, everyone.